morning, everyone. Welcome to this session one, which is Unit 1 Accounting as an Overview. So, the objectives of this particular learning outcome, or what we are going to discuss in this particular Unit 1, would be what is the need for accounting, what is the definition of accounting, what are the objectives of accounting, what are the advantages, what are the disadvantages, that are the limitations of the each and every branch of accounting. So, we have three branches that we are going to discuss here. The fourth is identify the parties involved in the accounting information. It could be internal parties, it could be external parties. Identifying the stages involved in the accounting process. And lastly, we are going to discuss some generally accepted accounting principles in the accounting, which is also known as GAAP, generally accepted accounting principles. Introduction, why do we need accounting? So the basic need for every businessman or the every business to is being able to answerable all these stakeholders. It could be internal, it could be external, the profit, the loss, the revenue, the taxation, and the financial position of his business of a particular time period for each and every stakeholders and all the interested parties. So this is the basic need for each and every businessman to have accounting information in the financial position need. We are also going to discuss the different stages in the accounting process and the different standards to maintain the uniformity in the accounting practice. Coming to the next part, we have already discussed the need of accounting. Why do we need accounting? A businessman or a business should need account in terms of creating a financial position to be able to answer all the stakeholders. It could be internal stakeholders, it could be external stakeholders, and to interpret the results of their business operation to the various interested parties. Now, coming to the definition of accounting, the definition of accounting includes collection, recording, classification, and representation of the financial data for the inner management, for the benefit of management, and to the outside party. So now we have cleared the outside agencies or the outside parties involved: shareholders, creditors, lenders, investors, government, etc. Basic need here would be it should be created or conducted in the uniform and the orderly fashion, and they are established in a way that it creates the financial condition of the enterprise and it shows the results of the business operation that the business has done. So this is the basic definition of accounting. Coming to the fourth part, which is the functions of accounting. The first part would be identifying the financial transactions, like writing and creating the financial transactions, the rough part. Then recording that particular rough part into a transaction manner, then recording a financial transaction. Third, classifying the transaction, classification in terms of service or in terms of total sales, total purchase return, total sales return. Then summarizing the particular transaction in terms of what are the net purchase, what are the net sales. Then interpreting the overall summarized results. Now the interpretation of results can be divided further in two sections. For the management, which is for the inner management use, so that they can make a better decision using the results, and for the external management to create a better decision or to make a better decision as per their individual need and demands. So the results are for the internal management, make a decision. The results are for the outside management or the outside parties to make a decision as per their particular need and their particular demands. Now coming to the second part, which is the objectives of accounting. The basic objectives of any accounting would be to ascertain the profit and the loss of the business, which is to find the financial position of a business and to make a systematic record of the transaction and to provide the accounting information to all the interested parties. As we have already discussed, the interested party here means internal as well as the outside stakeholders. Now coming to the other part, which is what are the parties or which are the parties that are involved in the accounting information. Now the parties involved in the accounting information could be external, could be internal, it could be shareholders, lenders, creditors, management, employees, citizens, anything. Each and every person who is attached to product for creating the service or delivering the service is a part and a partner of the accounting information. Now what are the need that they want? They need the financial position. Second, for what? To compare the present performance with the past year performance, or to compare the performance of a particular firm A to compare it with the performance of a particular firm B. Now the question arises, what are the shareholders? So shareholders are nothing but the owners of a particular business. Manager are nothing but who manages a particular business. Government is nothing but the ruling party of that particular country or the economy. Employees are nothing but who are working in that particular business. Investors who have invested their money and in return they have got the equity or the ownership of that particular company. Lenders who have lended their particular funds as a debt to a company. And the creditors to whom the company has lended in terms of the investment purpose uh, by creating the asset for the business. So these are the parties involved or the parties interested in the accounting information. Now coming to the accounting as a part of the information system. Now we have divided accounting as an accounting and the non-accounting information further into financial accounting and the managerial accounting. Now the financial accounting is nothing but it is for the objective for the outside management. So financial accounting is a need for the outside management. The outside management would include creditors, lenders, suppliers, shareholders, tax authorities, etc. So the financial accounting is for the outside party. On the other hand, we have managerial accounting, which is for the inner management to make the inner management decision more effectively, more efficient, and also to evaluate the performance of a particular firm. So financial accounting is for the outside party, managerial accounting is for the inner party. Now, coming to the branches of accounting. So, we have three categories in terms of branches of accounting. First, we have financial accounting, which is the need to be presented to the outside stakeholders. Accounting and management accounting are for the purpose of the inner management to create more efficient decision or to create more efficient management of a particular product and a particular service. So, these are for the inner management, which are cost accounting and the management accounting. Now, coming to the first branch of accounting, which is the financial accounting. So, the financial accounting is nothing but the art of recording, classifying, summarizing in a significant manner all the money transactions. Now, what is the art word? So, the art word is, as we know, financial accounting is for the purpose of creating a value for the outside management. So, in terms of creating the art of recording is nothing but to choose the best possible way to record a particular transaction so that it becomes a sweetener or it becomes a good way of representing or good way of showing to the outside party the operations of the business. So the objective of the financial accounting is to find the profitability and to provide information about the financial position in the best possible way, which is the art of recording. It could be in the income and the expenditure account statement, or it could be in the balance sheet. So financial accounting is nothing but the art of recording, the way we are recording the transaction for the outside parties, and also the need and the objective is to find out the profitability and to provide the information for all the concerns in terms of balance sheet and the financial and the income and the expenditure statement. Now coming to the functions of financial accounting. The functions of financial accounting is recording information, communicating results, managerial decisions, interpreting and financial information. Now, recording a particular information is the art of recording or art of delivering. Second, communicating results is how we communicate or how we interpret the particular results of a particular interpretation. For the managerial decisions and how we let them how we interpret a financial information for the outside part. So these are the functions of the financial accounting. Now also there are certain kind of limitation for the financial accounting. There are also certain kind of limitations for the financial accounting. The first one is the historic nature. For example, when we create a financial accounting, which is creating a balance sheet, creating the income statement, or which is nothing but the income and the expenditure account, we always record the transactions that business has done in the past. For example, if you're creating a financial accounting for year 2023, we are going to record all the transactions that we have done in the year 2022. So it's a historical nature. So it's a limitation for the financial accounting. Second is the recording on the actual cost. For example, there is certain way of recording the cost. It could be capitalizing a particular cost or it could be creating the expense. So there are certain kind of limitation regarding recording on the actual basis. The third one is the quantitative information. We would definitely record all the quantitative information, but we would not be able to record all the qualitative information in terms of the brand value and in terms of creating value for the customer. So these are all the qualitative information. So this is a kind of the limitation for the financial accounting. Another limitation would be to fix the particular price. For example, a product price or the service price can never be fixed. It depends on the demand and supply of the economy or the country. But for creating the financial accounting, we are forced to fix a particular price. So this is a kind of a limitation in terms of creating the financial accounting. The fifth one is the lack of uniformity in the accounting principles. For example, inventory valuation, inventory recording has a certain kind of principle. So each asset or each liability in the financial accounting has a different kind of principle. So each principle is different from the other one. So there is a lack of uniformity we are indulging into for creating a financial accounting. So this creates a kinds of a limitation in terms of creating the financial accounting. The last one is the technological revolution. For example, a sudden technological change that can create a huge impact on the financial accounting. So that would create a negative impact on the outside stakeholders. So this is a kind of the limitation for the financial accounting. And as we already discussed, financial accounting includes the art of recording. So with the art of recording, we are also being able to manipulate a particular transaction or manipulate a particular account in such a way that it becomes a more sweetener to the outside party. So this also acts like a kind of the limitation for creating the financial accounting. So this is a kind of the basic financial accounting limitation that we are forced to deliver. Now, coming to the second branch of accounting, which is cost accounting. As we already know that financial accounting are unable to meet the information needs about the cost structure because financial accounting are created with the objective to deliver with the outside party. But the cost part is for the inner management. So financial accounting are unable or are not able to meet the information needs about the cost structure of a particular product or the particular service. So cost of accounting is nothing but the process of accounting for the cost. Such cost accounting is good technique for ascertaining the probability and the profitability for decision making. For example, if a company needs to make a decision regarding what should be the cost of the new launch product, which is some kind of a similar on one of the existing product that the company serves. So for this, the company needs the cost structure of that particular product to make a good sense of what would be the profitability margin or what could be the cost margin or what would be the profit margin on that particular product. So for this reason, we need the cost accounting, which financial accounting are not been able to deliver. Now coming to the other part, which are the functions of cost accounting. So the basic functions of cost accounting would be to fix the particular price. What are the needs of cost accounting? To fix the price, to minimize the cost of the particular product by giving more cost data. By providing cost data, it it gives an edge to the management for comparing a particular product into different time phases. It also helps management to create the price of a particular service, product, or a job that they are providing. They are also good for creating or determining the profitability or the expected profitability for each and every product and the services so that they are answerable to the outside parties. So in return, it creates a more efficient or it creates more efficiency for reducing the cost, creating the price, fixing the price. So it reduces the waste and the cost of the particular product. But this is for the inner management purpose. So the financial accounting is not able to meet this particular need. But also there are certain kind of limitations with the cost accounting. The first one is there is no common system for the cost accounting. For example, each and every department of the firm has a different kind of need, a different kind of product, and a different kind of service to deliver. So each and every department has a certain kind of need that needs to be addressed. So there is no common system regarding the cost accounting. So this creates a lot of inefficiency in terms of comparing the cost data of a particular firm with the cost data of the other particular firm. There's no common system for creating the cost accounting. The cost accounting are generally done for a big organization. But the purpose for this is Big organizations have a certain kind of big data or a certain kind of large amount of product that they're delivering. So they need a particular cost information for each and every product. So these are generally done by the big organizations. Also, it is considered very narrow in its perspective as it fails to consider the revenue aspect. For example, cost structure only focuses on the cost part of the particular product. It does not involve any aspect of the revenue. So it considers itself as a very narrow concept for creating and focusing only towards the cost part of the particular product and not the revenue aspect. Now coming to the third point, which is the management accounting. So the management accounting is the process of identification, measurement, accumulation, analysis, and preparation of the financial information used by the management. So used by the inner management for the inner purpose to plan, evaluate, and control within the organization. So management accounting, as we have already discussed, it is for the inner management to assure the use of the proper accountability and the resources. For management accounting helps the inner management to plan, evaluate, control the organization in the most appropriate way so that each and every resources are being used optimally. So management accounting is for the inner management to plan, evaluate, and control within the organization so that each and every resource or each and every asset is being used in the most optimized way. Now coming to the other part, which are the limitation of management accounting. So management accounting has a certain kind of intuitive bias in terms of intuitive decision making, in terms of personal bias. For example, the one who is creating the management accounting has a certain kind of personal bias while creating the management accounting, because management accounting is forced, the objective is towards creating the inner value. So it could be having some personal bias by the maker of the particular management accounting. And for making the decision, there could be some intuitive decision making bias. It is a very costly system in terms of each and every department of the particular firm would be having each and every demand and the needs that to be addressed. So for creating or addressing that particular need for each and every department, it is a very costly process for a small firm to address the need and the demand for each particular department. So it is a very costly system for a small firm to address the management accounting. Now coming to the financial accounting process, there are four steps, which is recording the transaction, classifying the transaction, summarizing the transaction, interpreting the results. Recording the transaction is basically roughly recording the transaction in your ledger or the trial balance. The second is classifying the transactions in terms of the total sales, total revenue, total sales return transaction, total purchase return transaction. So classifying the transaction based on the need of the accountant, and summarizing the particular transactions in terms of summarizing each particular data set in terms of what we are interpreting. And the final step would be interpreting the results. Now, interpreting the results would be different for each particular need. For example, financial accounting for the outside party would be having a different need and a different purpose. At the same time, the results of this particular financial accounting for the inner management would be different for the inner management based on the needs and the demand of the inner management. So this is the holistic overview about the process of the financial accounting, which includes recording, classifying, summarizing, and interpreting the results based on the needs and the demand for each and every stakeholder. Now the accounting information, the standard accounting information, the standard accounting equation is the total assets of the particular firm would always be equal to the total equity plus the total liability. What I mean by this is balance sheet left side item, which is the equity and the liability, would always be equal to the balance sheet right side total, which is the total asset. So the total asset of a particular business would always be same as the total equity plus the total liability of a particular firm. So this is a kind of the standard accounting equation that an accountant follows for creating the accounting process. Now coming to the question, what we are discussing right here is, now let's discuss the first question, which is Mr. X started business with 1 lakh. The business received a cash of 1 lakh, which is an asset to business. So how can we create a particular entry? So in terms of the standard accounting equation, we have received the asset of 1 lakh, in terms of cash. So cash is an asset for business. So we have received the asset of 1 lakh. So on the other side, we would also be receiving the liability or the capital. So here we have the capital because the business has started. The Mr. X started the business. So it is the owner money. So it is the capital. So the assets would be equal to 1 lakh, and the capital, which is the owner's equity, would be equal to 1 lakh. Now coming to the second question, which is business has then purchased a furniture worth rupees 15,000, and in return they have paid in cash. So the old equation was satisfying the asset is equals to liability plus equity equation, right? So 1 lakh cash and 1 lakh capital was been settled. The new transaction is the business has purchased a furniture and paid 15,000 in cash. So the cash is asset. So the asset is reduced. So in cash we will deduct 15,000. On the other side we have received the furniture. So furniture is an asset. So we have received 15,000 as furniture. So now again our equation matches, which is the total asset is a 1 lakh. The total liability is again 1 lakh. So the new transaction is we have received the asset of 15,000. We have paid in cash. So we have reduced our asset in 15,000. So the net effect is zero. Coming to the third transaction, business purchase goods on credit from Mr. Z, which is the outside party, for rupees 10,000. So the old equation was tallied that the cash was 85,000 because we have paid 15,000 to purchase a particular furniture. We have received the furniture worth rupees 15,000. So we have the total assets now of rupees 1 lakh. On the other side, we have the total owner's equity of 1 lakh rupees. The new transaction is we have received or we have purchased goods on credit. So we have not paid yet. So now we have received the goods. So goods are nothing but the stock. So stock is an asset. So we have received the stock worth rupees 10,000. So our asset has increased by 10,000. So now we have 1 lakh 10,000 in our asset side. And on the other side of the balance sheet, we have not paid the purchased goods. We have purchased them on credit. So the credit is the liability. I'll be paying this particular 10,000 in future. So it's a liability for now. So on the other side, we have 1 lakh, which was the initial owner's capital, and 10,000 additional, which is the 10,000 liability. So again, we have created a new equation which matches a standard equation, which is total asset is equal to the total liability. The total liability involves the owner's equity, which is the capital, and the liability of the particular business. Now coming to the fourth transaction, the business sold goods worth rupees 7,000 on credit. In this transaction, the asset will be reduced because the business has sold the goods and the goods are stock. So on the asset side, we will reduce the stock by 7,000. But in return, we have not received the cash yet. So our cash have not been increased, but we have sold them on credit. So we'll be receiving them in future. So it's sundry debtors. So the net effect is the total asset, the stock has reduced by 7,000. On the other hand, the asset has reduced by 7,000 and the asset has increased by 7,000 in the terms of sundry debtors. So the net effect is again same. The total asset is 1 lakh 10,000 and the total liability is again 1 lakh 10,000. So we have matched this standard equation, which was the total asset would always be equal to the total liability. So we have matched this particular standard equation in each and every particular transaction that we have done. Coming to the concepts to be observed at recording stage would be business entity concept. That is, the business is a separate entity and the owner of the business has a separate entity. Or the owner loan has a different entry and the business loan has a different entry. Money measurement concept, objective evidence concept, historical record concept. Historical record concept is nothing but we are recording the transactions based on historical operations of a business. The fifth is the cost concept, creating the cost accounting, creating a fixing the price, and the dual aspect concept. For example, each and every entry or each and every transaction would be having the dual effect. For example, if the entry has been put on the asset side, then it would be again having the second entry on the asset side or it could also be having the second entry on the liability side. But at the end, the standard accounting equation should match, which is the total asset should always be equal to the total liability. Now, coming to the last slide of this particular unit one, which are the reporting stage, which are the GAAP, General Accounting Accepted Principles. GAAP, General Accepted Accounting Principle. The first concept is the going concern. So while creating the accounting, they're putting an assumption here that the business is the going concern, that the business will last forever. So that we're creating business in terms of the business will last forever. So this is basic assumption. We are creating this accounting for a particular period. This is the accounting period concept, the accounting period concept. What is the matching concept? For example, if I have created the goods worth rupees 10,000, but I have sold goods worth rupees 15,000 or worth rupees 5,000, so I'll only record the cost of that particular 5,000 that I have sold. So it's like a matching principle. The revenue shown for X number of unit should be same as the cost of goods sold for the same number of units. The fourth is the conservatism. We will record the loss first and will delay the future profits. Consistency concept, full disclosure concept, and the materiality concept. So these are the particular generally accepted accounting principle that we are follow: going concern concept, accounting period concept, matching concept, conservatism concept, consistency concept, full disclosure concept, and the materiality concept. One thing we need to focus here once again was, while creating each and every entry here, we were focusing towards at the end, we need to make sure that the standard equation has been matched. For example, on the first equation, we have matched the total asset was same as the total liability. In second, in spite there were two entries on the asset side, the new equation was matching with the standard accounting equation, which was total asset was again same as the total liability. Third, in spite that we have not received, sorry, we have not paid in cash, the accounting asset, the total asset was same as the total liability. So the basic need for the accounting standard equation is any entry you make has a double effect. So this is what we have discussed here, double aspect concept. Each and every would be having minimum of two entries in the accounting system. It could be both on the asset side, it could be both on the liability side, it could be one asset, one liability, it could be one liability, one asset. So, but it would also be having it would always be having the dual aspect concept in terms of recording the transactions. And this was the basic GAAP, which is generally accepted accounting principle: going concern, accounting period, matching, conservatism. Conservatism concept is nothing but we would be recording the future losses fastly into our accounting process, but we would not be recording the future profit that fastly in our accounting process. So we are kind of creating a certain kind of conservatism in our particular accounting reporting stage. This was all from my side. Thank you so much. This was unit one, accounting as an overview. Thank you so much.